Today, we're focusing on financing corporate real estate. The key here is understanding how to evaluate the costs, risks, and returns associated with holding, renovating, or selling income-producing assets. Every investment decision starts with the asset itself, so we need to carefully assess its performance and potential before moving forward. This approach helps ensure that we make informed choices that align with our financial goals and risk tolerance. On this slide, we're focusing on the key objectives related to managing corporate real estate effectively. First, we'll look at disposition strategy, which involves analyzing market timing, understanding your exposure to capital gains, and exploring reinvestment options like a 1031 exchange. This helps in making informed decisions about when and how to sell properties. Next, we'll evaluate renovation and capital improvements. This means identifying which upgrades can increase the property's value, boost rental income potential, and enhance overall performance. It's about making smart investments that pay off in the long run. Then, we'll move on to financial assessment. Here, we apply financing and planning concepts to weigh the costs, risks, and returns of different choices, whether to hold on to a property, renovate it, or sell it. These financial insights are crucial for making sound decisions. Finally, remember that the core decisions in corporate real estate boil down to three main actions: sell, improve, or decide to hold. Understanding these options and their impact on your real estate portfolio is foundational to effective management and financing of corporate real estate. Here we have the corporate real estate decision tree, which is designed to guide us through making strategic decisions about our assets. The first key question we ask is whether the property generates stable cash flow. If the answer is yes, we then evaluate if the asset requires low capital expenditure. When both conditions are met, holding the asset often makes the most sense. Next, if stable cash flow isn't present, we assess if it's the peak pricing window or if there's an opportunity for a tax-efficient exit. These factors help determine whether selling the asset would be advantageous. Alternatively, if we see potential for net operating income upside and the value gained exceeds the project cost, renovating the property could be the best move to enhance value. The ultimate goal here is to identify the path that creates the strongest risk-adjusted outcome for the asset. Essentially, this decision tree helps us balance cash flow, cost, timing, and risk to make informed, strategic choices in financing and managing our corporate real estate portfolio. Let's take a closer look at the key factors that influence when to sell corporate real estate. First, market conditions play a crucial role. Ideally, you want to sell during periods of strong pricing, low vacancy rates, and active buyer demand. These conditions help maximize your sale price and ensure a faster transaction. Next, interest rates significantly impact buyer affordability. Higher capital costs can reduce valuations and lower transaction volumes, since buyers may be less willing or able to pay higher prices when borrowing becomes more expensive. Conversely, lower interest rates tend to boost buyer enthusiasm and support higher valuations. Then, competitive supply is another important consideration. When new inventory enters a market, it can create downward pressure on rents and occupancy rates. This excess supply can also negatively affect exit pricing, making it harder to achieve top dollar when selling. Overall, timing is everything. Understanding how these elements, market conditions, interest rates, and supply dynamics, interact can help you choose the optimal moment to sell and maximize the value of your corporate real estate assets. Here, we're looking at the impact of paying taxes immediately after sale versus deferring them through a 1031 exchange. When you sell an asset and pay the tax due now, which in this example is $2 million in recognized gains, including capital gains and recapture, you lose a significant portion right away. 76 cents for each pre-tax dollar goes to taxes at disposition. That leaves you with a lower amount of equity to reinvest, in this case, $480,000, and essentially results in $0 being kept working for you, limiting your buying power. On the other hand, by deferring the gains through a 1031 exchange, you can redeploy more equity into your next investment, allowing you to maintain 100% of your capital working for you. This strategy increases your buying power and keeps your capital working in the market, which is the key to growing wealth strategically. Ultimately, the tax question boils down to capital allocation, whether you pay taxes now and reduce your investment potential or defer taxes to maximize the capital you have to reinvest. This capital gains tax strategy is critical to effective financing in corporate real estate, helping you leverage your equity for more substantial investments over time. Here, we're focusing on the concept of the 1031 exchange, which plays a crucial role in financing corporate real estate. Essentially, this exchange allows you to sell an income-producing property and reinvest the proceeds into another qualifying property without having to pay capital gains tax right away. It's important to understand that the tax is deferred, not forgiven. This deferral means you preserve more of your equity, allowing it to grow and compound in the next asset. The property you sell is known as a relinquished property, while the new property you acquire is called a replacement property. This strategy is powerful because it enables tax-deferred growth, helping you build wealth more efficiently within your real estate portfolio. Let's talk about the key requirements of a 1031 exchange, which is crucial for financing corporate real estate. First, the replacement property must be held strictly for business or investment purposes. Personal properties don't qualify. Also, the properties exchanged must be like kind, meaning they should be similar in nature or character. There are strict timing rules to follow. You have 45 days from the sale to formally identify potential replacement properties. Then, the acquisition of the replacement must be completed within 180 days after the sale. For full tax deferral, you must reinvest 100% of the proceeds into replacement property, and the new property must be of equal or greater value. Missing any one of these rules can cause you to lose the tax deferral benefit entirely. So it's essential to stay on top of every detail throughout the process. Now, let's take a closer look at the reinvestment opportunity analysis. The key here is to carefully compare your current asset against potential replacement options before making any decisions to sell or exchange. We evaluate each property option based on several important criteria, including cash flow, appreciation potential, market growth, and risk profile. For instance, holding the current urban mixed-use property offers stable cash flow with moderate appreciation and limited market growth, carrying a medium risk profile. On the other hand, Exchange A, which is an industrial flex property, shows strong cash flow, high appreciation, and high market growth, but with a higher risk profile. Exchange B, a medical office, presents good cash flow, moderate appreciation, and strong market growth, all with a moderate risk level. Lastly, Exchange C offers moderate cash flow and appreciation with steady market growth, but the lowest risk profile among the options. After weighing these factors, Industrial Flex stands out as leading due to its balance of income, growth, and risk, making an attractive financing option for corporate real estate investments. This structured analysis helps ensure that any reinvestment decision aligns strategically with your investment goals. When we focus on property renovation, we're essentially driving strategic value creation. By making targeted capital upgrades, we can significantly increase the property's overall value. These improvements allow us to offer more competitive, market-ready spaces, which in turn supports the ability to charge higher rents. This approach not only revitalizes underperforming spaces, but transforms them into stronger, more attractive assets. Ultimately, these enhancements boost investment performance by improving occupancy rates and increasing cash flow, making property a more profitable and sustainable investment. On this slide, we're looking at the main categories involved in capital improvements for corporate real estate. These improvements can be grouped into several key areas. First, structural or system upgrades are critical because they address the core functionality and longevity of the building systems. This not only lowers operating risks by preventing unexpected failures, but also often leads to improved efficiency. Next, aesthetic enhancements play a big role in making properties more attractive to tenants, which can directly influence faster lease-up rates and higher tenant retention. Modernizing the functionality of a space ensures it meets current standards and tenant needs, making it more competitive in the market. Sustainability improvements are increasingly important. They help reduce utility costs significantly, typically between 15 to 30%, and support greater environmental responsibility. Together, these categories of capital improvements work as a comprehensive strategy to finance and optimize corporate real estate assets, adding value while managing costs and risks effectively. Here, we're looking at the financial impact of investing in property renovations. The initial outlay or renovation cost is about $400,000. This amount is essentially the capital we've put into upgrading the property. In return, we see a significant increase in the property's value, about $550,000, which represents the appraisal uplift after the renovations. Additionally, the annual rental income increases by $90,000, boosting the net operating income potential. When we compare these numbers, the illustrative net value creation comes to approximately $250,000. This slide really highlights how strategic investment in renovations can generate a strong return on investment by increasing both the property's market value and its income-generating capacity. Here, we're looking at three main financing options for renovations in corporate real estate, each suited to different needs and circumstances. First, traditional bank loans typically offer lower interest rates, but they come with tighter underwriting standards. These loans usually have longer amortization periods and can have fixed or floating rates. They're best suited for stabilized assets that have predictable cash flows, making them a more secure option for lenders. Next, construction loans. These tend to have higher interest spreads because they're tied to the risk of the specific project. Their terms are usually short, with draw schedules that reflect the progress of the construction. Construction loans are ideal for major repositioning projects or significant value-add initiatives where funding is needed to complete substantial changes. Finally, using cash reserves or refinancing is another approach. This option isn't subject to lender spread or the resetting of debt pricing, offering more flexibility in timing and fewer approval hurdles. This method is best for sponsors who want to prioritize speed and maintain greater control over the process. Each type serves a distinct purpose, so understanding the project's goals and risk profile is key to choosing the right financing strategy. When managing renovation projects, it's crucial to recognize and prepare for key risks to keep everything on track and within budget. First, budget overruns are a primary risk. To mitigate this, it's essential to use contingency reserves and consider fixed scope bidding to control costs up front. Second, a market downturn can significantly impact project viability. The best way to handle this is by stress testing rents, property values, and exit assumptions before committing capital, ensuring you're prepared for less favorable market conditions. Third, extended timelines can cause delays and additional expenses. Phasing construction and maintaining liquidity reserves help address schedule slippage effectively. Overall, the best practice is to underwrite the downside rather than just focusing on the upside, which means planning for the worst-case scenarios to safeguard the project's success. When comparing financial outcomes of holding versus selling an asset, it's important to consider several key factors. If we choose to hold, we benefit from an annual cash flow of about $420,000, and after debt service, our net operating income remains stable at zero, meaning the income stream continues without interruption. Over 5 years, we can expect appreciation of around $1.8 million, assuming a 3.5% annual growth rate, which effectively locks in value that accumulates over time. Holding also provides ongoing tax advantages through depreciation, offering a tax shield benefit, reducing overall tax liability by about $640,000 over time. On the other hand, selling the asset results in immediate liquidity, with net proceeds of approximately $6.2 million available for redeployment. However, this comes with significant tax impact, including capital gains and depreciation recapture. The decision essentially boils down to whether the future cash flows and appreciation gain from holding the asset outweigh the immediate gains from selling and reinvesting the capital. For stable assets, patience often pays off, rewarding investors who are willing to hold and benefit from steady income and appreciation rather than opting for quick liquidity. When we talk about the cost of capital, it's important to understand that ownership costs actually exceed the cost of debt. This means that capital is being consumed across the entire asset, not just through debt payments. So, when underwriting, we must take into account the full drag on returns, not just the debt service. For example, debt service here is 7.8%, but there are additional costs like maintenance reserves at 2.1%, property taxes at 1.9%, insurance at 0.8%, vacancy risk at 1.6%, and opportunity cost at 2.4%. All of these add up to a total cost of ownership of 16.6%. This comprehensive view gives a clearer picture of the true burden ownership places on returns, which is essential when financing corporate real estate. Let's start by looking at the top line revenue, which includes the gross income generated from potential rent and any other income sources related to property. This is where our analysis begins, understanding the total income before subtracting any property level costs. Next, we account for operating expenses. These include taxes, insurance, maintenance, and administrative costs. It's important to note that capital expenditures and financing costs are excluded here because they are treated separately. After subtracting operating expenses from the gross income, we arrive at the net operating income, or NOI. This is a critical metric because it reflects the asset's unlevered operating performance, showing how well the property generates income from operations alone. Then, we consider the debt service, which includes both principal and interest payments on any loans associated with the property. This step captures the impact of financing on the overall cash flow. Finally, by subtracting the debt service from NOI, we determine the cash flow available. This figure is crucial for making decisions about whether to hold, renovate, or sell the property. Understanding this cash flow helps guide strategic choices in managing corporate real estate financing. Here, we're looking at the relationship between risk assessment and return expectations across different strategies. Each strategy falls somewhere along a trade-off curve between capital risk and expected upside, which means the more risk you're willing to take, the greater the potential reward, but also the possibility of loss. Stable cash flow strategies typically lower both risk and return. For example, holding properties primarily for steady income results in limited upside, but provides consistent returns with lower risk. On the other hand, value creation strategies like aggressive renovations increase both execution risk and potential upside. These approaches require more involvement and carry more uncertainty, but they offer significantly higher returns if successful. Disposition strategies, such as selling and redeploying assets, shift the focus to timing the reinvestment and discipline in redeployment, making market timing a key factor in realized returns. You can think of the spectrum from lower risk and lower return to higher risk and higher return, with various strategies positioned in between. Refinancing offers moderate risk while improving liquidity, and 1031 exchanges provide tax efficiency and repositioning potential, balancing risk and reward differently. Understanding where a given strategy falls on this risk-return curve helps us make more informed decisions and align our approach with our investment goals and risk tolerance. When it comes to asset disposition, timing is crucial, and it works best when market signals are in alignment. Let's break down some key market conditions that influence this process. First, interest rates play a significant role. Higher borrowing costs can put pressure on pricing and reduce the number of potential buyers, which can impact your ability to sell quickly or at a premium. Next, cap rates are another critical factor. When cap rates expand, it usually means that valuations are dropping for the same income. So understanding where cap rates stand helps you anticipate market value shifts. Finally, demand trends matter a lot. Tenant demand and leasing momentum directly affect not just pricing and timing, but also your overall hold strategy. Keeping an eye on these three components, interest rates, cap rates, and demand trends, will help you make the best decisions when financing and disposing of corporate real estate. Here, we're looking at three different scenarios to understand how shifts in the market can affect investment performance. Starting with the base case, we see a net present value of $2.8 million and an internal rate of return, or IRR, of 13.4% over a holding period of 5 years. This represents our most likely outcome based on current assumptions. In the downside case, the NPV drops significantly to $0.9 million, and the IRR falls to 9.1%. Additionally, the holding period extends to 7 years, reflecting a slower return under less favorable market conditions. Conversely, the upside case shows us a more optimistic picture, with an NPV rising to $4.6 million and IRR of 17.8%, while the holding period shortens to 4 years. This illustrates the potential reward if market conditions improve and our assumptions prove conservative. The key takeaway here is how sensitive the investment's value is to changes in these assumptions. It's crucial to test different scenarios thoroughly, as small shifts can have a big impact on returns and timing. Understanding the sensitivity helps us make better financing and real estate decisions. Here we focus on the key elements that influence corporate real estate financing and overall asset performance. First, consider renovation and rent upside. These factors directly impact the asset's value and income potential. Disposition and market timing are critical for deciding when to sell or reposition an asset to maximize returns. Tax efficiency, financing options, and cost of capital all play vital roles in determining debt capacity and the true cost of holding or acquiring properties. At the center of this framework is the concept of convergence, where financing, renovation, and disposition strategies come together. The goal is to reach an optimal decision point that balances maximizing returns while controlling risk. Ultimately, the strongest strategy seamlessly integrates capital structure, value creation initiatives, and exit timing to drive the best financial outcomes for corporate real estate investments. This holistic approach ensures informed, strategic decisions that enhance overall portfolio performance. Here, we have a case study demonstrating the hold and renovate strategy in action. The property in question is an 82,000 square foot suburban office building. While it maintained stable occupancy, its common areas were outdated and in need of modernization. The renovation scope included updating the lobby, creating a new amenity suite, upgrading the HVAC system, and refreshing the exterior. We invested $3.2 million into these targeted upgrades. The outcome clearly shows that this approach paid off. The rent increased by 14%, occupancy improved to 94%, and the return on investment was an impressive 18%. This strategy of holding and renovating proved to outperform an immediate sale by expanding income potential before eventual disposition. It's a strong example of how thoughtful capital improvements can enhance asset value and drive better financial results. Here, we have a case study that illustrates the successful execution of a 1031 exchange in corporate real estate. The relinquished asset was a mature office property sold for $12.4 million. This property was facing lease rollover risk and had low growth income alongside rising capital needs, which ultimately triggered the decision to sell. In its place, a newer logistics facility was acquired for $14.8 million. This replacement asset offered a longer lease term, stronger regional demand, and importantly, stronger rent growth with lower downtime risk. This acquisition effectively upgraded the portfolio by moving capital into a higher performing asset class. The exchange process involved engaging a qualified intermediary before closing to ensure compliance. Within 45 days, 3 replacement property options were identified, and the industrial property closed on day 172, preserving the tax deferral. As a result, $2.1 million in capital gains tax was deferred and rolled into the new investment. Key outcomes included an increase in net operating income from $820,000 to $1.03 million, improved tenant credit quality, and significantly reduced rollover exposure. Additionally, leverage remained disciplined at a 65% loan-to-value ratio. The strategic lesson here is clear. Timing, compliance, and reinvestment quality are crucial. A 1031 exchange delivers the best results when the replacement asset is not just larger, but fundamentally better in terms of performance and risk profile. Here, we have a comprehensive decision framework designed to help you evaluate every critical aspect before making a major move in corporate real estate. First, it encourages you to assess how well the property fits with your overall strategic goals and market conditions. Understanding your financial position and tax situation is also essential, as these factors heavily influence the feasibility of holding or renovating real estate. The timeline matters too. Know when you need to act and how that aligns with your objectives. Additionally, consider your risk tolerance, renovation potential, and financing availability, because these elements shape the level of investment and risk you can responsibly take on. The key takeaway is to pressure test every major decision, whether you plan to hold, renovate, refinance, or sell, so that you're making well-informed, strategic choices. This framework, from Module 15 on financing corporate real estate, serves as your checklist to navigate complex decisions with confidence. Now, Let's talk about 4 common mistakes that can quietly erode real estate returns and how to avoid them. First, poor market timing is a major pitfall. The best way to fix this is through thorough data analysis. Understanding pricing trends, cap rates, and overall demand can make all the difference. Second, underestimating renovation costs often leads to budget overruns. To prevent this, always build contingency plans and budget for unexpected expenses before any work begins. Third, ignoring tax implications can seriously impact your bottom line. Professional guidance is essential here. It's important to carefully plan around gains, depreciation, and exchange rules to optimize your tax position. Finally, capital depletion can create cash flow problems. Running stress tests to protect liquidity in downside scenarios is a smart move to keep your financing healthy. Keeping these points in mind will help avoid costly errors and maintain strong returns. Here are the key takeaways to keep in mind when financing corporate real estate. First, always sell with intent. It's important to consider the timing, potential tax implications, and reinvestment options, as these factors will significantly affect your net proceeds. Second, when renovating, focus on improvements that enhance net operating income, increase resilience, or boost your property's exit value. Third, before deciding whether to hold or sell an asset, conduct a thorough side-by-side analysis of cash flow and return on investment to ensure you're making the best choice. Fourth, remember that financing has a cost. The structure of your debt impacts your risk, flexibility, and overall returns. Finally, test your assumptions with sensitivity analysis to see how your strategy holds up under different scenarios, ensuring it remains viable even when conditions change. These principles will help guide sound decision-making in corporate real estate financing. Now, let's talk about the next steps in developing your real estate strategy. First, assess your current portfolio by reviewing asset performance, capital needs, debt structure, and your market position. This is crucial to understand where you stand and identify areas for improvement. Second, model different scenarios. Compare the outcomes of holding, renovating, selling, or exchanging assets under realistic assumptions. This helps you evaluate the potential risks and rewards of each option. Third, consult with advisors who have expertise in tax, legal, financing, and valuation matters. Aligning their insights before committing capital ensures a well-informed strategy. Finally, execute your plan by prioritizing timing, funding, and accountability so your careful analysis translates into effective action. Remember, a disciplined process always beats making reactive decisions, setting you up for long-term success in corporate real estate financing.